Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing the company Delta Airlines. Now the controversy is going to start right here, I can already tell, because well, Delta Airlines is actually one of my favorite airlines. In my previous job I traveled a lot internationally and I always chose essentially Delta Airlines for the flight. So you know, I think that they're the best out of the main airlines in the United States, but that's beside the point, right? Guys, they do have earnings tomorrow, Wednesday open. Guys, also remember, tomorrow CPI is coming out as well, so we might see major moves all over the place. But seeing that, again, their earnings are actually tomorrow before open, I figured, you know what? Let's analyze this company, analyze their fundamentals, and see what we could actually find even 2 years after the COVID fiasco that destroyed every single airline. So with that said, let's get started with this analysis. Alright guys, we are going to come right into the spreadsheet because unfortunately Delta Airlines doesn't actually have any dividends. Now they used to. I actually used to own this company before. However, because of COVID, they did suspend their dividend and they have not reinstated it since, and probably will never reinstate it again, seeing that they got very badly hit due to COVID. But nonetheless, guys, we got the ticker symbol of DAL, market cap of almost $20 billion, PE of 39.39, which is massive in accordance to at least what I like to buy a company at, which is around 20 or below. So with a current share price of $31.09, yeah, we might actually want to buy this at a lower, cheaper price, believe it or not. So that's just essentially that. Now they don't have a dividend, as I said, which means that their average free cash flow and their last year's free cash flow is going into themselves to reinvest. We're going to take a look at how this graph actually looks like in just 1 second, so bear with me. But just letting you know, because they don't have a dividend, all their money is going right into themselves to grow the company. Now guys, let's take a look at some of these fundamentals. Boy, they do not look good, but it's understandable, right? Starting of course with the net income 5 years ago of $3.2 billion to 1 year ago, guys, of $280 million. That is, guys, a decrease of 91% on the 5 year. And unfortunately, this is really bad to see, because even though this company is currently decreasing their net income, well, it's because of the fact that, again, COVID happened. You can see that from 5 years ago to 3 years ago, they were actually doing fairly okay, right? They were increasing their net income, you know, slowly but surely. And then COVID hit, guys. 2020, boom, negative $12.4 billion. To be fair, this was 100% due to COVID, and every single airline, and including cruise ships, got completely crushed. So this is an understandable number. So the fact that they were able to rebound from negative 12.4 billion to a positive 280 million, that's really good, guys, right? That is a $12 billion jump, right? A $12 billion difference. So, you know, to their credit, yeah, they are decreasing on the 5 year, but you need to understand why this occurred. And obvious, of course, is because of COVID, so can't really blame them for this. Coming out to the free cash flow, the most important profit metric, because guys, this is what companies use to essentially do everything, right? They use this to pay out a dividend, to grow the company, make acquisitions, they pay down their debts, they buy back shares, essentially just operate the company at a corporate level. Cash flow is everything. So we want this, guys, to be increasing. Now we get the exact same thing that we just saw with the net income, right? 5 years ago of $1.1 billion to 1 year ago of $17 million. That is a decrease of 98%, with a 5 year average free cash flow of $158.4 million. Again, same exact thing, COVID related, right? 5 to 3 years ago, really solid, right? Nice and steady growth. But COVID hit. 2 years ago, negative $5.7 billion, which is unfortunate, but look at it from the good side, guys. After 1 year, they were almost able to make up $5.7 billion in overall cash flow difference, which is, again, really good, seeing that this negative cash flow was something that they could not control. And now lastly, looking at the revenue, we got 5 years ago of $41 billion to 1 year ago of $29.9 billion. Essentially, guys, $30 billion. So that is, again, another decrease of 27.32%. And same exact thing, COVID happened. Nice increase from 5 to 3 years ago. COVID hit, boom, it dropped down to $17.1 billion. And then they shot back up to almost $30 billion in 1 year. So there's nothing else for me to say on this. Now let's take a look at, guys, some balance sheet numbers. Assets minus the total liabilities. Can this company survive if, for example, COVID hit by selling off their assets, right? So what this says is, do they have more assets than they do liabilities, which includes their debts? So you want this number, guys, to be increasing. Now, again, it's a COVID related issue once more, right? Currently, they're at around $3 billion or so in this difference. However, take a look at it from 5 to 3 years ago, very steadily increasing. COVID hit, boom. Essentially, their liabilities took major jump, and probably their assets also went down as well. But even then, they were still able to keep positive 2 years ago at around $1.5 billion. And again, they have increased it ever since. Average total assets around $66 billion. Average liabilities around $57.8 billion. Doing this difference, we get $8 billion in the positive. Now let's take a look at, guys, the cash flow minus liabilities. Cash flow is what companies use to pay out their debts, right? So we want to see this year over year in regards to their cash flow. So what I did was I took their cash flow, right? And then I took their liabilities, added them together. And essentially what I'm trying to look for is the company's cash flow superseding, or at least somewhat superseding, to their liabilities? And unfortunately, again, we see another COVID related number, whereas currently they're at $68.5 billion in the red, meaning that if you take the cash flow minus liabilities, their liabilities exceed their cash flow by around $68.5 billion. But here's also the thing, right? This was after COVID. If you take a look at it from 5 years ago to 3 years ago, they were essentially flat at around like the $43 billion average in the red, right? COVID hit, obviously, the cash flow went down, so this difference got a lot bigger. But ever since then, they have been decreasing this difference for all intents and purposes. And when we take, guys, the average cash flow minus the average liabilities, we get around negative $55 billion. And now, guys, let's take a look at the most important metric that people tend to overlook, and that is the shares outstanding. This one tells you whether or not the company is diluting you as the investor. So very important metric, because you do not want a company to be issuing shares. You want a company to be buying back shares. As it stands when it comes to Delta Airlines, actually fairly surprising. And here's the reason why. 5 years ago of 704.6 million shares to today of 638.1 million shares. On the 5 year, that is a decrease of almost 9.5%. That's not too bad. Now, from the previous year to the current year, they did increase it a little bit at around 0.2% or so. That's not much of an increase, right? And honestly, to their credit as well, look at this. They were doing a very nice steady decrease from 5 to 3 years ago. COVID hit. They decreased it again from 640.2 million shares to 636 million shares. But then after COVID, they issued a little bit of shares here and there to 637. And then they issued again from 1 year ago to today to 638. So, you know, I think that they're just doing this because they just don't want to take on any more debt. Can you really blame them? I necessarily don't. The fact that they still have a negative 5-year value when it comes to their shares outstanding pretty much is telling me that if they do this for a couple more years and then eventually slowly start to buy back, you know, they may have a little bit of issuing shares in the 5 year here and there at one time. But aside from that, I don't think it's going to be that big of a deal. And lastly, looking at the cash equivalents, they currently have $7.7 billion with an average cash of around $5 billion. Alright guys, now it's time to make some assumptions, low, medium, high, using 3 different factors. Of course, revenue growth, projected share buyback, and of course, the required rate of return. So, for the required rate of return, starting off, I like to keep it flat, 10% to match the S&P 500. For the revenue growth, guys, let's use Seeking Alpha's growth tab. And as you can see right here, the revenue growth year over year is a whopping 177.38%. Forward is 43.61. Will they be able to do this, guys? This to me is very big, and the airline industry is rough out there, right? Especially with all of these restrictions that are currently going on around the world, right? So we take that into account. So as a result of that, guys, I'm going to put in the revenue growth for Delta at around 10%, 12%, and 14% for each assumption, respectively. And now for the projected share buyback, well, we did see that they were doing at around 9% or so, but I think that they'll continue to keep it roughly around the same, maybe buy back shares, but a little bit less within the next 4 years, assuming everything continues to go the way it is, which is less restrictions as well as easing up when it comes to the airline industry. So at this point in the game, guys, I'm going to say 5% for the predicted share buyback for the lowest assumption, 7% for the median assumption, and give them the benefit of the doubt and go with 9. So I think they're going to be doing the same. Let's just say everything goes back to normal. They'll be able to do 9 again in the next coming 4 years. So with that, guys, we actually get the target share price not adjusting for debt. As you can see right here, for the low assumption, it is $17.99. For the median assumption, it is $19.62. And for the high assumption, it is $21.37. Now, unfortunately, when it comes to the target share prices after debt, we cannot do this because, unfortunately, the market cap that the calculator comes up with is lower than that of their net debt. And the fact that they actually have a lot of net debt kind of makes this market cap overall negative. That is essentially why we're getting a negative dollar price when it comes to the target share price after debt. So unfortunately, we can't really take a look at this, but we can take a look for a second opinion at the book value per share as well as the tangible book value. Now, the tangible book value is kind of weird when it comes to this, but again, we just got negative values when it comes to the target share price after debt, so you'll see what I mean in just a bit. But when it comes to the book value per share, guys, currently it is at $4.69. That is a decrease of 74% from 5 years ago, around $17 or so. The thing is that unfortunately, because of COVID, right, this company's book value per share got dropped to $2.41 2 years ago, and they have recovered to around $4.69. But taking a look at this before COVID hit, because let's face it, nothing really changed in the company after COVID, right, except for the fact that countries just shut down. If you just take a look at, guys, what the company was worth before COVID, well, we can pretty much see that it's in line with my target share prices, not adjusting for debt, right? So that gives credence as to essentially what I'm trying to say here is that the company should be worth at around the $20 mark or so, at least when it comes to the book value as well as the target share prices in discounted free cash flow. Now taking a look at the tangible book value, this one is a little bit more bad because, well, this one only takes into account, guys, everything that is tangible. Now you're saying, well, Delta Airlines has planes. Yeah, and for some reason, we're getting this in the negatives. Even before COVID, the tangible book value, guys, was negative $3, right? Now, after COVID, today, essentially, it is negative $20. So it is a decrease of 567%. And again, seeing the fact that they've always been negative, they've only had 1 year that was positive to 65 cents when it comes to the tangible book value per share 3 years ago before COVID, you know, at least my target share prices after debt are essentially telling me that it's in the negatives, right? And we're seeing that the tangible book value is also in the negative, so it kind of gives credence to that. So now looking at these price to book value and price to current tangible book value per share ratios, we can pretty much see if the company is overvalued or not, right? Currently, for the price to the current book value, we get a ratio of 6.63. Guys, that is overpriced. Essentially, what this is saying is that it's about almost 6.63 times more overpriced than what it should be. You want the price divided by the book value to be as closest to 1 or under 1 as possible, because at 1 it is trading at book value, under 1 is under book value, and above 1 it is over book value. So you want it to be as close to 1, and at 6 is telling me that it is overpriced. Now to the current tangible book value, well, we get a negative 1.55. I don't think that this should be trusted because, again, we got negative tangible book values, right? So that's essentially what my point is when it comes to this one. I don't think it should be trusted. Even my target share prices after that shouldn't be trusted either. So essentially, these are the valuations when it comes to Delta Airlines, at least using my assumptions for discounted free cash flow and a second opinion using book value. Now, guys, when it comes to these, again, every investment is the present value of all future cash flow, and this isn't financial advice. All I did was, guys, make my own assumptions. That's why I have this calculator available for free, so you guys can make your own assumptions. And you guys can even take a look at this book value as well in your own time, because this one is also available, and I also have a re-evaluation as well. And even, guys, a dividend tracking sheet. All for you guys to have, all for free. All I'm asking for in return is like, subscribe, comment, and just help me grow my channel. Thank you so much for the people who have subscribed. And if you're on the fence of subscribing, think about it. It's free. And if you change your mind later, then you can just unsubscribe later, right? But it is free. And if you guys are enjoying this, please just help me grow my channel. That's all I'm asking for. All in all, guys, Delta Airlines is a company that I actually liked. Believe it or not, this was actually the only airline that I owned prior to COVID. Now, I did sell it when I saw that countries were shutting down. Even before COVID hit the US, I was just like, this is not looking good. So, boom, sold it, and thank God I did. So, yeah, that is essentially what my 2 cents are on this. Guys, they do have potential. I'm not saying they don't, right? If you saw their fundamental, it wasn't their fault that they did that bad. It was unprecedented circumstances around the world. So they do have potential, but from a dividend perspective, which is what I like to do, yeah, this is not necessarily that good, but they do have potential when it comes to growing their fundamentals in the future. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube, as I said. You can follow me on my new tech sites, link in the description below. So with that said, peace out, and be on the lookout for the next stock analysis video.